On the program, we're talking about some of the big things to be thinking about as you hit those big birthdays. So in the last segment, we were talking about some of the things to be thinking about when you hit your 50th birthday and what to be thinking about as those years in your 50s unfold. We'll shift now to this segment. Okay, you're hitting 60. What are some of the things that you need to be thinking about in that decade as well? And the reality is that it's a lot about Social Security and Medicare, right? So, of course, at 62, you've got the potential to collect Social Security. But a couple of caveats on this one. First caveat is it's going to be a lot less money than you would have gotten at your full retirement age, which for most people these days is age 67. The other part is that, and this is the part that I think a lot of people get tripped up on, between 62 and your full retirement age, which for most people is 67, there is a limit on how much work income, how much earned income that you can make. Now, work income, earned income is sort of as it sounds. It's money that you get by, in essence, punching a time clock somewhere. And yes, I know people don't punch time clocks anymore, or few people do punch time clocks than they used to, but that's conceptually what that type of income is that Social Security looks at to determine whether you've got to give back some of your Social Security. And the number's relatively low. Every year it changes, so next year will bump up a little bit. It's basically around $23,000, $24,000 of earned income that you can make. If you are above that and you are collecting Social Security before your full retirement age, which again for most people is 67, then guess what? For every $2 that you are above that limit, you've got to give $1 of that Social Security back. So very quickly, if you're still working and or maybe even you've gone on a part-time basis, but that still is generating $40,000, $50,000 a year, you don't want to collect Social Security early, because not only will you get less money, but you're going to have to give it all back if you're still working and making $40,000 or $50,000 of work income, earned income. The kicker there is that retirement income doesn't count towards that. Pension income doesn't count towards that. A number of things don't count towards that when we think about other sources of income. So interest, dividends, retirement income, those do not count towards being that earned income that could possibly impact your Social Security. So certainly a decision at 62. The other decision that basically is at 64 3/4, if you will, 3 months before you turn age 65, is the notion of signing up for Medicare, because that is the time to sign up for that. The Part A part, you really should sign up for no matter what, because that's the part that does not have a cost involved with it. Whether you sign up for Part B or not is a function of whether you're still working, whether your employer is providing you your health coverage, all of those kinds of things. But certainly to know that, hey, at 65, that's Medicare age, and that's going to be an important decision for me to make, and certainly something that I need to do, particularly as it relates to Part A. 67, as we mentioned, that's your full retirement age. Be careful of that work income limitation. We actually had a conversation just this past week. Somebody said, okay, hey, I'm 65, I've got Medicare, so I'm good on my health insurance. I'm going to apply for Social Security, and I'm going to reduce my work hours, and everything's going to be great. And then my question was, well, that's great. You're going to reduce your work hours. How much are you still going to make? And they said, well, if I reduce my work hours, I'm still going to make about $40,000, $50,000. Game over. You're not, it doesn't make any sense to collect Social Security, because you're going to wind up having to give it all back at that level of work income. So just be aware, full retirement age, 67. If you were born before 1960, then it drops back. 1959, 66 and 10 months. 1958, 66 and 8 months. You get the idea. Born after 1960, well, then it is, in fact, 67 is your full retirement age. So those are the things to be aware of and thinking about when you're in your 60s. In your 70s, well, there's a couple of different things to be thinking about. First, at age 70, if you have delayed taking your Social Security, well, then guess what? That is the maximum amount and effectively the longest that you can delay taking Social Security. I suppose you could further delay it, but it wouldn't really come with any increase whatsoever. So at 70, Social Security fully maximizes out. So if you've delayed it, then At 70, then you can say, okay, I'm now going to start to collect it. Obviously, it's immaterial because you're past your full retirement age about how much other income you're bringing in from work or what have you, because once you're past your full retirement age, and there's no earnings limitation in terms of what you can make and not have to pay that Social Security back. So, but at 70, it maximizes out in terms of the most amount of the benefit that you can get under Social Security. 70 and a half used to be the required minimum distribution age for money to come out of your retirement accounts. That's not the case now. Now it is 73, where you've got that required minimum distribution to the extent that it is your account. Don't forget, if you inherit a retirement account, then you've got a required minimum distribution typically right away, particularly if the person that you're inheriting it from started or had to take their own required minimum distribution. If they had to do that, then you've got to also continue on that required minimum distribution. So at 70 and a half, though, that age still exists as it relates, to doing a qualified charitable distribution. So on a qualified charitable distribution, that's the ability to give some of your IRA directly to a charity and get an immediate tax deduction. Not really a tax deduction, it's more of not having to report the income from a retirement perspective. So those are some of the important ages for you to consider when it comes to ultimately thinking about some of the financial things that you need to be thinking about in your 50s, in your 60s, and in your 70s. Excuse me. Certainly some important things to be thinking about as it relates to the kinds of financial things that you want to be thinking about as you hit those ages. So certainly those are big milestones and some of the things that we certainly are here to talk about on the program on a regular basis. So welcome, of course, into Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name, of course, is Joel Garris. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, one of which, Kristen Cayley, is going to be joining us next week on the program to talk about some of the big tax changes for this year. So make sure you listen in on that program, because we'll have a lot to share with you on that one. If you're interested at any time in connecting with us, visit our website, nelsonfinancialplanning.com. There you'll find various icons that will connect you, for example, to our podcast platforms or maybe our LinkedIn page, or you can check out our blog posts as well. We got a couple of them up that are relatively new. One about the hard landing versus soft landing economically, what all of that means, along with some of the energy tax credits that are available this year. So you make sure you check out all of that on the website. And then, of course, on the website, you can request free copy of the book, Next Gen Dollars and Cents, as well. Well, as we were saying, running to the end of the year, and here we are with about 3 weeks to go. One of the things that we always like to talk about at this stage in the year is some of the things that you may want to be thinking about to help improve your tax picture, right? The reality is that when we think about the year, there's still some time left in the year to start to think about, okay, how can I take some action to ultimately save me money on my taxes. Now, the reality, of course, is that if you're going to save on your 2023 taxes, you got to get it done by December 31. So that's 3 weeks and a day from the airing of this program. And so consequently, we wanted to share with you some of the thoughts on that. One of the biggest things that you want to be doing as you think about taxes and how to minimize, how to save money between now and the end of the year is you've really got to be checking your tax withholding and your estimated taxes. And the reason for that and why you need to be doing that much more this year than you have in any other year for a number of years is the interest cost. If you owe money as of October 1, 8%. That's a pretty big cost and certainly a pretty good reason to check where you are on your tax withholding for the year 2023. So we're going to talk about that more after this break here on Dollars and Cents with Joel Garris of Nelson Financial Planning.